the combination of all this, the withdrawal of liquidity on an already fragile economy is something very concerning. I think it's something is about to break. I need to think about where could I be wrong here?
Hi everyone. Today we have Tavi Costa, Crescat Capital Portfolio Manager. He has a big Twitter presence where he talks about the economy and how things are going in the US and elsewhere. And we're here to talk a little bit more about how the economy is doing. Can you go a little bit more into what's happening in the US economy today?
Yeah, sure. Well, thanks for having me. I think there's, a lot of things going on right now, but one of the things that is really calling my attention is the fact that we're seeing economy rolling over, right? We're seeing leading indicators back 2 to 3 months ago was certainly showing that. And from ISM manufacturing indicators, I think were one of the most important ones. We're yet to see some of that translating to contraction of growth in earnings of most companies and even worse macro conditions as a whole. But leading indicators are important. They were showing that things are getting worse. You're seeing the yield curve inversions as well, which is a huge deal. You're seeing consumer sentiment collapsing. And so at the same time, equity markets are which are also leading indicators, are starting to price the same scenario, which is, I think, very negative for the next 6 to 12 months. The usual, I would say, behavior from policymakers when you have a situation like this is to add liquidity in the markets. We've seen this progressively larger monetary policies to help the economy when you are at this problem here since the late 80s and so forth. And so today it's sort of a lot different than that. It's quite opposite, even from 2020 crash when the Fed had to come in and announce that they're going to be doubling their balance sheet size. On top of it, they're going to be slashing rates to zero. They're going to be buying all sorts of ETFs in the junk bond market and so forth. I mean, the market was completely different than what it is right now. We're seeing the same degree, if not worse, of problems. Credit spreads are widening. You have most junk bonds have declined significantly. You have a problem in equity markets with NASDAQ down close to 30%. And the Fed is not backing off. They're going to add more to the issue, meaning they're going to tighten more monetary conditions. If you look at the balance sheet today, they're going to start shrinking their balance sheet by $95 billion this month, already started per month. This is one of the largest quantitative tightening policies we've seen in history. And then on top of it, you have the interest rate hike situation, which only adds to this issue. So the combination of all this, the withdrawal of liquidity on an already fragile economy is something very concerning. And you can do that until you start seeing labor markets begin to really deteriorate, because those are the mandates, right, of a Federal Reserve, is price stability and employment. Well, they've completely shift their focus from 2021, which was on employment, when unemployment rates were at near record levels, all the way down to levels that we're now today at near record lows in terms of unemployment rate, and switch it to price stability. So that price stability place is not an excess liquidity backdrop that we saw in the last decades. And so that shift, I'm not sure, we're really going back to the other place anytime soon. So, what it means to markets is that, I think unemployment rates is the next shoe to drop. They're probably going to drop, meaning they're probably going to start rising in a more accelerated fashion than others believe. And that's when the Fed is going to be in a very difficult scenario. And let's not forget what's going on with especially 10-year yields that I think hold the key for the global economy. And the issue of 10-year yields not reacting the way they have been in the prior 2 to 3 decades, meaning there's changes in correlations happening right now, I think it's very meaningful. and it will become a problem here too. So I don't want to extend too much. Obviously, I already talked too much here in this answer, but that's sort of what's in my mind here in the US.
I love this summary of the economy. Can you talk a little bit more about how, when we see the inversion of the yield rates, right, from positive to negative, like the 2-year to 10-year, we usually see a recession, right? So we've seen a recession in the past, and usually the way the Fed reacts is basically by injecting liquidity or reducing interest rates. And we're heading into, we're already in a recession, right? And we see the inversion of the yield curve, and the Fed is increasing interest rates at the same time as tightening. What's the worst case scenario? What can happen, next year? Are we going to see something break, or what's going to happen to the economy?
I think something is about to break. I mean, honestly, you have, to me, the biggest issue is in the Treasury market. I mean, the yield curve is an important signal. I have I track all the possible yield curve spreads in the Treasury curve, and when you get up to 70% of yield curve inversions, that's a very strong signal all the way back to the 70s that you're going to have a recession. And a recession is not really what matters if you're in the markets. If you're a market participant, what matters is the downturn. The recession is what happens after the fact, is you defining it, this downturn, as what is called recession. The Fed, I just posted this chart the other day on the Fed Atlanta GDP now, which ultimately is really trying to estimate what the GDP quarter over quarter changes this quarter, is about 30 basis points from turning negative, right? So that's, it's going to be very obvious we're in a recession. You're from Brazil as well, so you know how inflation is it's one of the worst enemies of any policymaker. Usually that is linked to big changes in the political environment. Like, say, Brazil back in 2015, 2016, that was the case when a lot of people think there was a lot of other triggers that caused the impeachment of the president at the time. And no, it was really, in my view, is the economy, the macro side, that leads to political instability. So it's the inflation problem that got out of control that then exposes all those other issues. And today it's going to be the same, in my opinion. You have inflation problem, you have the very high risk of already being in a recession. I think we are. If we're not, we're very close to it. Who knows? When the markets are down as much as they are, you should probably be, it's probably a real downturn, but it's different than the last 30 years, because the last 30 years, the yield curve inversion was caused through a different signal. Right now, we're not seeing 10-year yields fall, right? The other yield curve inversions that we saw between 2-year versus 10-year yields was caused by the Fed hiking rates and the 10-year yield falling. It's happening because the hiking is part of the cycle is happening, but we're not seeing the 10-year yields falling at all. It's just that the front end is rising faster than the back end. But the back end of the curve, which is the 10-year yield, is extremely important, because everything is justified by that, right? So every time you discount free cash flow models and so forth, everything is using the 10-year yield, and therefore, when you have the 10-year yield reacting in an environment that is an inflationary era type of behavior, which is what you saw back in the 70s, and people get hung up, they're like, oh, this is like the 70s. Well, it's similar, but it's not precisely the same. There's a lot of different macro imbalances and macro aspects of today's environment that make it very different than the 70s. But in a way, this entrenched level of inflation developing in the system is very, very similar. And so you have a Fed, which people hate when I say this, but the Fed is being forced to tighten monetary conditions. Don't get me wrong. They don't want to tighten monetary conditions. Who wants that? It's obvious it's going to decelerate or trigger a downturn in the economy, which is going to create a lot of other issues. Inflation is the worst, outcome that can really cause a lot of pain for policymakers. Nobody wants that. So now we're seeing a shift of a total focus on bringing inflation lower at almost all cost. And so it's hard to believe something is not going to break. And the problem with the 10-year yield is that the whole world is looking at the 10-year yield from a demand lenses, meaning, it's maybe it's being caused by the geopolitical problems, maybe it's being caused by inflation persistently growing, maybe it's being caused by the oil move that we've had in the last months or so. And I would say the very, very last months, oil has been obviously going lower, but in the last 2 years, oil has been going higher. So commodities have been going higher. So maybe 10-year yields are involved with that. But in my opinion, it's a lot deeper than that. I mean, we're seeing the largest issuances of 10-year, 20-year, and 30-year treasuries that we've seen in history. And that's because the government's broke. The government cannot, the revenues is lower than what they've been spending. Their fiscal agenda is one of the largest and most extensive we've seen in history. It's being caused by peak inequality things, that have been the Green Revolution, the risk of unreliability with China and having to rebuild the manufacturing plants in the US. All that is causing massive government spending. And the government spending, if you're not making revenues, it's like a company. You have a deficit. And that deficit causes an increase of debt. An increase of debt causes issuances of treasuries. And they can issue treasuries all over the curve, from 0 all the way to 30 or even higher than that yields, right? And they've been issuing most on the long end because the long end is actually cheap relative to other parts of the treasury curve. But that's creating a supply imbalance of that because there's too many treasuries and not too many buyers. I'm happy to get into the buyers side of it as well because it's very interesting. But that's for me, that's really the sort of root cause of this issue is almost like it's the 10-year yield that is causing a lot of the pain here, along with inflation, along with other imbalances. But the 10-year yield should not be understated of how much is the impact of that in equity markets.
Yeah, that's super interesting. I think I saw a chart showing that I think the US is going to pay around $700 billion of interest expenses. So only with interest expenses, you're spending so much money out of your, balance sheet of the federal government, which is crazy to think about. Can you go a little bit more into detail about, the liquidity, like the problems of, treasuries, and if there might be some liquidity problems, in the near or long term?
Yeah, you can sort of break down the commodities, the treasury market into 3 demand, pockets. I mean, you have one, which is the household pocket. The other one, or you can call 4 pockets. The demand that comes from households, the demand coming from U.S. banks, which is a very significant one, the demand coming from the Federal Reserve, and the demand coming from outside institutions. Back in the 40s, we had a World War II. And in order to finance the war, well, you need to issue treasuries. And so they did. So government debt to GDP reached, 140% levels. And at that time, there was a nationalist agenda, sort of spreading in the US. And therefore, a lot of households decided to buy those, what they were called war bonds at the time, in order to finance the war. That was a huge part of the demand side of it that really drove the kind of financially repressed environment that we saw in the 40s, where yields actually never went higher like we saw in the 70s. But that was because of that sort of large demand driven by different parts of the treasury market. Today, households are not buying treasuries. You don't see households investing in that in order to help the Green Revolution, in order to help peak inequality. It's quite different environment. We're not seeing that major demand from that side. And you look at U.S. banks, or let's talk first about the Federal Reserve. The Federal Reserve was the largest buyer of those treasuries. And now they reverse that role, and they are actually letting those securities mature. They're not selling them, they're letting them mature. but it's just normal mechanics. If the treasuries are maturing, they have to reissue them. It's a rolling debt problem because it's not like we have revenues to pay down the debt. So what you do is you roll another debt. So if the Fed is not the one net purchasing those treasuries, somebody else needs to buy those. Well, who is it going to be? Well, they thought that the U.S. banks were going to be buying them because the U.S. banks have been the second largest buyer of those treasuries over the last 2 years. And guess what? In the last 6 months, U.S. banks are now sellers of treasuries. This is the first time in I think 6-7 years. And so now you have a problem here because U.S. banks are also not buying them. And then your next step is, well, maybe the foreign institutions are going to buy it. Now you have a geopolitical problem where, the U.S. caused some painful political changes with Russia that I think brought up a lot of attention in terms of, what if they, freeze or accounts or treasury accounts. In other economies have started to worry about those issues. They also have another problem. Most developed economies and emerging markets, I would say most developed economies are suffering from a depreciation of their own currency. Well, this is another different topic, but it's related to the treasury market because what we're seeing here is that the treasury market in the U.S. is collapsing. It's causing interest rates to rise. It creates differentiation, interest rate differentials to increase. It creates further demand for the dollar, right? So you're seeing the mechanics. So the dollar is getting stronger versus other developed economies. In other developed economies, the way they need to think about this is, oh my gosh, we need to improve the quality of our international reserves. And how do you improve the international reserves is not by buying debt from another indebted economy, which is treasuries. You got to buy tangible assets. You need to buy gold and other things that have historically created that environment of higher quality assets that can attempt to improve the credibility of those fiat currencies. That's key. But we're not seeing that either. And so yet, I think we're going to see it. That's my gold thesis, right? My gold thesis is related to central banks buying and so forth. So you're seeing most foreign institutions selling treasuries right now. This is a huge deal because I don't think any of the aspects in the pockets of demand from the treasury market are really advancing their interest in buying those instruments. At the same time, we're seeing record amounts of issuances. So it is a liquidity problem. And so, ultimately, what you're seeing with the Japan situation where they have to peg 10-year yields and they have to buy almost unlimited amounts of JGBs. It's going to happen with the U.S. at some point. It's unsustainable. I don't know what the level is. It's 4.5%, 5% that they have to come in. This is completely unsustainable, and I think it's a huge part of why we're seeing equity markets react the way they are.
So is that the end game? Is Japan the future of the U.S.? Basically, the U.S. doing yield curve control and the dollar depreciating somehow compared to other currencies? Is that what's going to happen at some point, or what do you think it's going to happen? After the Fed realizes that a recession, which I think is going to be probably a depression, because theoretically, it will probably last 2 years or more, I think, because it'll take some time for the Fed to react, and then it takes some time, for the reaction of the Fed to hit the markets. So it will take some time for this recession to recover. How is the Fed going to react? Are they going to reverse QT? Are they going to do QE again? Are they going to do yield curve controls? What is the Fed going to do, when they see the shitstorm that we're the place where we are,
Yeah, I don't think we're there yet where the Fed really reverses. I mean, but if you're a macro investor, if you're a trader, your idea really is, okay, there's more pain to go before we get there. If you're a macro investor, I think you want to be building a portfolio of ideas that can really be unleashed by those Fed actions of having to either cap yields, 10, 20, 30-year yields to not rise at a certain level. Otherwise they're going to default on the debt. So all those questions are coming. They're not here yet, but they're going to be here soon. And that's what's going to drive a lot of other macro ideas. So you're going to have, we're from Brazil. I think Brazil is going to do very well in this environment, because if the Fed can't really do much and sustainably tighten monetary conditions, because the global economy cannot handle this level of dollar movement, but also 10-year yields movement, or also the Fed funds rate movement. Certainly they cannot stand this level of financial conditionings tightening right now. And so at some point the Fed has to reverse its policy. And if they do, it's going to be, I think it's going to be a very different environment than we've seen in the prior decades. I think even different than the 70s, because the 70s, we didn't have what I call the trifecta of macro imbalances, where you have the debt problem of the 40s, the inflation of the 70s, and the valuation problem of the 90s, late 90s, and the valuation problem of the late 20s before the Great Depression. And those are real political, create real political constraints. And so it's hard to believe we're going to see, a very active Fed. We're seeing that now because we're getting out of, we're starting from zero, right? Literally rates are at zero. They just doubled their balance sheet. So they're trying to normalize situations, but normalizing from ridiculous levels. And so, where would 10-year yields or the Fed funds rate need to be to really help with the inflation problem? They have to be at least double from where they are right now. And so those are the problems that I can see. So I think there's more pain to go. I think there's going to be a very steep recession, in my opinion. I don't know if a depression is going to be the case, and it could be. I think from a market participant standpoint, you don't need to get it right as far as if a depression or a recession. You need to get right the direction, and the direction seems lower, not higher. And I've been I have had a bearish bias in the U.S. for a while, right? I mean, I'm not saying this is a new thing for me either. I mean, I've been building a portfolio of ideas because of that for a while too. And in my opinion, you want to be ready for the next 5 to 10 years. You look at commodities to equity ratio. Commodities is going to be a huge opportunity, because when they realize that they can't sustainably tighten monetary conditions, you're not going to see oil at the current levels. You're not going to see most likely copper at the current levels. You're probably not going to see cement at the current levels. You're probably not going to see agricultural commodities at the current levels. They're going to be much higher, and that's going to drive gold and silver as well. And so today, this idea of being able to buy, let's say, properties, companies that have properties or mineral rights in areas that the market is basically saying, from a price perspective, that you don't have anything, but they're actually onto major discoveries according to our probability models, it's kind of a no-brainer. And so it's, I just want to accumulate as much as I can on that side of the market before a big move. I think this is going to be kind of like a big trade, a big, remember the big short, and it's going to be kind of the big long, right? The big long and the big short, meaning equity markets. Think about the people in our age, that they have their bullish biases, right? They all have their bullish biases. They've seen way too many times buying the dip work. So they are, conditioned to think that way. So it's going to be a lot of a painful period, in my opinion.
Interesting. So why do you think commodities will go higher again? Can you expand your thesis?
Because commodity markets and the cycle of commodities is predicated on really one thing. There's a lot of other things that are important, but one thing is incredibly important, which is the capex trend. So when you have a capex trend that is secularly lower, meaning we're seeing declines of most capital spending industries in the natural resource space declining for a while now, it creates a lot of issues, especially now because you also have the political effort against mining, against developing mines, against exploring. And I would say that's mostly in developed economies, some emerging market economies and frontier markets. You still can see some of that happening. But the impact of that, if you just think about this, right? If you're a mining company today or energy company today, it's just very difficult for you to justify to your shareholders that you're going to spend money on the ground to look for a new mineral. And majority of shareholders have seen this painful period of commodity producers where they've lost money for many, many decades. And there is a real pressure from shareholders. This is outside of the political side of it, which is tremendous and causes very large conservatism driven by most of the management teams. And so you're seeing, let's just use an example, Kinross. Kinross just announced they're going to be buying 300 million shares, $300 million worth of shares, doing buybacks. You know how much that is? That's 8%, 8.5%, almost 10%, if you think about it, in their floating shares. And so they're buying 1/10 of their shares every year right now. I mean, that's an extreme policy. What would I do if I was Kinross? I would spend at least 100 million on exploration, but they can't justify that and so what does that cause? There's a lot of unintended consequences from that. Well, then you don't see, if you don't spend money, you don't develop things. And so what's happening is that we have a lack of discoveries. So we don't have enough discoveries. So most of the major companies in natural resources, they have their reserves. They've been depleting their reserves as they generate free cash flow, right? So they deplete the natural resources in order to generate cash flow. And so they've been improving their balance sheets. They've been, fundamentally looking stronger and stronger across all commodity producers. But they haven't been investing in new things. So they need to replenish their reserves because they're facing a supply cliff. And so to me, this is a very clear signal for commodities. You want to be, pedal to the metal here. I mean, it's literally, at some point, the skills of being a geologist, of understanding natural resource projects, what is a good project, what's a bad project, what's a good company, what's a bad company, what's a good development, what's the financial model that works for running an exploration company. All those things are going to be huge skills in the next 5 to 10 years. And so, I think it's a major opportunity. So I'm bearish. I think this environment is scary and it's bad. We're seeing deglobalization, but it's extremely bullish for commodities, in my opinion.
Yeah, I agree with you there. One of the interesting things that you're basically stating is that commodity prices will go up, right? So that means that inflation will go up because commodities are the inputs for everything else, right? And oil, we're seeing oil prices are not went down a little bit this year. And I'm not sure if the dumping of the petroleum reserve is related to that. It seems that the administration is dumping a lot of oil into the market, trying to get oil down before elections. We will see oil and how do you think inflation? How do you see inflation a year from now? Even with interest rates going up, even with this strong recession, will get 2% inflation, or we'll get inflation 5% and a recession? Are we in a stagflationary environment? How do you see inflation next year and in the coming years?
Well, the problem here is the fact that inflation happens in waves, and so it's not just a straight line higher. Well, oil is not going to go up in a straight line higher, right? I mean, you have China collapsing. China is literally imploding. You have the government selling 1 million barrels a day of strategic petroleum reserves. How in the world are you not going to see a decline in oil prices? You have to. Right, but with China imploding, remember back in 2015, 2016, oil was imploding along with China. Oil is holding up well. Where do you think the Brazilian real should be with the Federal Reserve raising rates the way they are? It shouldn't be a 5.5. It should be a 9 right now, but it's not. So what does that mean? It means there's something else behind it. It means that there's very bad news that are not actually being reflected in prices, and I think this is extremely bullish. When you have, most of the times when you have bad news actually being perceived as positive in the markets like this, it's usually very good news. And I've been a supporter of this because I know what happened in the last 10 years, 20 years. The Brazilian trade has been the worst trade you could ever buy. Commodities has been the worst place for you to be in the last 10, 20 years, and at least since 2011. And so, but macro trends, they reverse. They're the worst, and now they're the best, and now they're the worst. So we've seen that, right? And so I don't think, back to 2009, if you look at the Brazilian Ibovespa in dollar terms versus the S&P is up like 400% from March 2009, which was the bottom of the global financial crisis. Brazil is actually down, I think, 20-30% from those levels. So, I love that. I mean, it's cheap. You got the banks, you got everything that looks really cheap. And so it's not going to be a straight line. There's no way. I mean, any of those trends that you've seen of technology, of any of those macro trends that are long-term, they're not a straight line. It's going to be very difficult. Oil was. I mean, look, the energy sector had its best year in 30 years in 2021. It's having in 2022 again one of its best years in 30 years. Nat gas was having its best years in 30 years this year again. So it's not like energy is not working. It is working. It's just having a break. It's just worked too much. Housing prices, it's related to commodity prices. How much is it going to cost for you to build a house in the future? So housing prices, if you look back, the housing market versus equity markets ratio back in the 70s, it went a straight line up, right? Because housing market outperformed the equity markets during that time. It's a tangible asset. Housing market did not go up from the global financial crisis all the way to the COVID era here. It went up, but not in a major way. Like compared to equity markets, it really underperformed. And then all of a sudden we had just a spiking move up in housing prices in 1 or 2 years horizon very quickly to kind of catch up to all those years that it didn't do anything. And then everyone's like, oh, this is a bubble. I don't think it's a bubble. I think this is the housing market is also very, very constrained. Supply is also not very historically high at all. I mean, it's quite the opposite. And so I'm not a buyer of real estate. I'm not saying this is what our fund is doing. We're focused on commodities. But I'm looking at this and I'm like, well, I want to be long tangible assets. And then I make a list of them. And I'm like, what's the most asymmetric bet I can find? And most people are seeing us, oh, Tavi, he just talks about gold and silver. That's not what I'm doing. My portfolio, there's 90 investments that we're buying in exploration assets. It's literally companies that have a ground that probably have our own 2 major discoveries. Are companies that are priced at close to zero market cap or sub 40 million market cap with the potential of being worth $2 to $3 billion. Those are multi-bagger kind of potential investments. I make tons of those. It's like a VC approach. And some of them are not going to work. Some of them are going to be killers. And so that's sort of the idea that I'm trying to do. I think you can do the same with Brazil. I think whoever knows how to navigate the Brazilian market in the next 5 to 10 years will do very well. Oh yeah, Lula comes in and the market's down 15%. What are you going to do? You're going to sell your stuff or you're going to be buying it? You should be buying it. There's going to be dip opportunities in both parts of the market. And I think you don't want to be a buyer of the equity market, but you want to be a buyer of those tangible asset ideas. Brazil, you can buy, why Brazil? Because it's a commodity-led economy. You can buy those exploration assets that I'm referring to. You can be oil companies. You can be agricultural commodities. All those look really interesting.
Interesting. So it seems that your thesis is related to the fact that there's not enough supply, right? And then because there's not enough supply, prices go up, and then you have these mining companies and whatnot post record profits and things like that. But as soon as you have a lot of profits, right, they will start investing into mining. But it takes some time, right? It might take a few years for the supply to go back up. So my question is your thesis for a certain time period? Like, is your thesis around commodities for, for the next 5-10 years, or is it, more than that?
No, I think I mean, right now, if you ask me right now, and I can change my opinion, 5 to 10 years seems like the right horizon, and that's because that's the usual time it takes to reverse those capex trends. Also, I'm a firm believer we're entering an inflationary era. If you look back in other inflationary periods like the 70s and the 1910s, those are times you want to be, buyer of commodities relative to expensive financial assets. Financial assets were not expensive in the 70s and the 1910s, and still you have commodities really outperform financial assets. I think that ratio idea is going to be even more of an aggressive movement to the upside than we saw other times. If I see capex trends at record levels in 3 years from now, I'm probably going to change my opinion. I don't think it's going to happen. You asked me what I think it's going to happen. I don't think that's going to happen. I think it's going to take a while for us to see that. We just said, like as I just said, the very significant movement in oil in the last 2 years. Have we seen capex increase for oil companies? No. Actually, oil rigs are declining in the last 6 weeks. First time since I think August of 2020 or July of 2020. So it's crazy to think. I mean, it's really unbelievable. I mean, what's happening, and so and pay attention to correlations. Look, just to finalize, if you are in an inflationary environment, everything is going to change. Correlations will change. They are changing right now. Remember, gold and the tips market, or gold and global bonds, used to be very correlated. Major breaking correlation. Global bonds are collapsing. Gold is down. It's not collapsing, but it's down a little bit. And you'll have other things also collapsing. And think about the stocks and bonds portfolio both collapsing together. That's a change. When was the last time we've seen that? Is it because this time is a different era than what we saw back in the last 20 to 30 years? If you're a macro investor, you got to be in front of those big changes, those pivotal moments in history. This is a pivotal moment right now. I don't think this is we're going to go back to a disinflationary era. This is very different. We've got 4 pillars of inflation: wages and salaries growing. We have reckless amount of fiscal spending happening. We have underinvestments in natural resource industries, the capex trend I was referring to. And number 4, which is the most important one, we have the beginning of a deglobalized world. So if anybody thinks that those 4 things are going to be going away anytime soon, I'm not a believer in that at all. I think this is the beginning of those. And if that's the case, this is an inflationary era. And it's going to cause a lot of things. It's going to be labor strikes. It's going to be people asking for more money. It's going to be the government saying, "Oh my gosh, we got to rebuild the U.S. Oh my gosh, we got to electrify the economy. Remember electric vehicles and the green revolution? We got to do that." Peak inequality. There's way too many differences between rich people and poor people. We got to give money to the poor people. Well, who pays for that? The government. And then you go there. Well, what about China? Well, can we? I'm starting my business, technology business today in the U.S. I need to manufacture this in somewhere. Where am I going to manufacture this? And comes China and says, "Hey, would you like to sign a deal with us to stay with us for 10 years? Are you going to sign it?" Well, capex of $100 billion for you to build a manufacturing plant and build your product for the next 10 years, really cheap. Labor is cheap. It's been cheap. Would you sign that contract? Of course not. You don't know what's going to happen. So majority of that is going to have an impact on reshaping manufacturing. And reshaping manufacturing is a huge deal because it creates demand for commodities as well. So it's going to be a lot of big changes.
Interesting. Yeah, I agree with you there. You actually made me more bullish on Bitcoin. I'm like a big Bitcoin believer because I think it's somehow, you're basically translating energy prices to the digital world. But yeah, on the gold thesis, you talked a little bit about, the price going down a little bit today, and bond market is doing very bad. But I think those are there are different reasons. I think the reason why gold's going down is because of liquidity. Everyone is looking for dollars. The economy is slowing down, and so you have a sell-off right now. But eventually, gold will outperform. I think there was another time that gold went down during a recession and then went up a lot. Is that what's happening to gold right now? Is that a liquidity problem, or is it something different?
I think it's maybe that, but I think also it's just look. I mean, imagine if you're a central bank and you're facing a problem of your currencies collapsing and you have to sell reserves. What are those reserves? Some central banks out there are being forced to sell gold as well. I also think that if you're a large pension fund, a large capital allocator that is investing for the next 5 to 10 years, it's very troubling to see the biggest hedge of your portfolio, treasuries and global bonds in general, not acting like one. And so, there's a lot of thinking here, happening like right now, right? I mean, correlations are changing. People are like, is this a real move? Are we going to go back to the world we were in the last 2 to 3 decades where bonds go up and markets go down, and or not? Or have we seen enough of that? And so, and we saw, the biggest, I think one of the biggest reversals of the Fed policy we've seen in history, which I don't think it's positive for gold. Unfortunately, I don't think that's positive. And so I think it will require a global economy collapse to cause, central banks to have to reverse their policy somehow, at least on a net basis, be less rather than more hawkish, in order to see that shift in gold prices. And why do I buy gold? Is because I believe in the story that first and foremost, what we're going to see is that if you're a believer that central banks can sustainably raise rates in this environment and kill inflation, don't buy gold. I don't think that's their trade. If you believe that we're going to see productivity improve in the next 5 to 10 years in a way where you're not going to need larger units of debt, larger units that relative to units of growth that is generating growth, then you should not be buying gold. That's not my view. I think we've seen debt, get to a level that it's going to be hard to grow much further than this. It could, and it's going to be very, very, very bad if we see that. And it could. I'm not saying we couldn't, but meaning it's not so much in the growth of the debt. It's much more related to how much debt you need to generate growth. If we see a reversal of the pattern of where we're seeing less debt for more growth, yeah, I don't think you should be buying gold at all. But that reversal in policy that we're seeing from the Federal Reserve of slashing rates to zero, doubling their balance sheet, now doing quite the opposite of all this, I don't think it's bullish either for gold. So if the global economy collapses, I think investors are going to start sniffing that around, meaning they're going to start realizing, oh my gosh, they're going to change their tune. If they change their tune, gold is not where it is right now. Gold has to be higher. So, I think it's important to see those changes, and it's like the Brazilian trade. You see equity markets down a lot on one day, 2, 3, 4% down on the Nasdaq, and then you look at Brazil and it's down 80 basis points, like less than 1%. And to me, this is happening way too many times. It's like there's the opportunity is knocking on your door. Almost, it's like it just seems a lot of signals here. And, again, those signals, they can be broken every now and then in the short term. Like, let's say Lula comes in and you have a decline of Ibovespa down 15% in a day. What are you going to do? That's the time to be accumulating assets in that period, because there's way too many political constraints for a guy like Lula and the change in political environment. It doesn't matter when you have a commodity-led economy, a commodity backdrop that is favorable for economies like that. So that's, I think that's a bigger and more important and more relevant side of the trade.
Interesting. Not to spend too much time on the recession, but I think it's really important for people to understand what's happening globally. China, for example, it seems that they have a real estate collapse, right? Like their real estate area of the economy is collapsing. Europe, you have really high inflation, and then you have the dollar going up. How is that going to affect the U.S. economy in the next year? Is that like, how bad is the situation in Europe and China right now? And how does that affect the U.S. economy and companies in the U.S.?
Well, so just to, share a little bit of my views on China. I've always been bearish on China. You can read writings all the way back to 2014. We were one of the very first hedge funds to short the Chinese renminbi. We made significant amount of money in 2015 on the valuation of 4%. Okay, it wasn't even major. It was a 4% devaluation. It was so cheap to put that trade on that we made a lot of money on that trade. It made our whole year in 2015 and 2016, and it collapsed the commodity market, right? Because it was not only that, you had the demand side collapsing from a second largest economy in the world, largest importer of commodities, but on top of it, you had the capex trend being at a peak. So, oh my gosh, it's like, you just got to, no way I would buy Brazil in that environment. It's a no-brainer. Just don't touch it. It's probably going to go lower. Then there you go. You have inflation going higher in a place like Brazil. You have an impeachment of the president and so forth. There's a lot of things happen during that period. This period is very different from that. I've always been a believer that a collapse on commodity markets is actually positive for China, not negative. China is a commodity net importer. And one thing that matters at periods of inflation, at periods where cost of capital is higher, not lower, like in the 90s, for instance, where cost of capital was much higher than what it is today across the globe, is that it creates a lot of interest rate differentials, and a lot of currencies trade in those with those metrics. Meaning, you got interest rates rising in the U.S. relative to China. That creates a higher demand for instruments in the U.S. because they yield more and it drives the dollar. So we're going back to a world like this where I think current accounts are going to start mattering again. So you have, what is the current accounts? Your exports versus your imports. The Chinese economic model has always been, we're going to purchase raw materials, we're going to sell final products. We're going to provide you all the manufacturing plant. We're going to give you cheap labor, and we're going to give it back to you, all these cheap goods and services that you can use across the globe. And that's an environment that works until commodity prices go higher. Commodity prices go higher. Think about this. Their economic model now is going to fail, and it doesn't work that way. And then you also have an economy that has levered up in the prior decades in order to have this being in this position, which you look at real estate, you look at just the banks. I mean, the size of the banks. I mean, my gosh, we have banking institutions in China with over $4 trillion of assets. And they're collapsing in prices. This is like Lehman Brothers, 50 times worse. I mean, Lehman Brothers had nothing in terms of assets relative to some of those Chinese banks. And no one talks about it. You know why? Because nobody owns them, right? It's really almost like a state-owned company environment. And so I think we need further dilution. We need further dilution of the currency. We need more. China is going to be forced to inject liquidity in an already inflationary environment. It's going to be forced to do that with the commodity prices actually staying high. They may not, surge, but they're staying high. And now think from my end. I am long a ton of inflation assets. I'm long I buy a ton of tangible assets, related companies and ideas towards that trade. I am short a ton of equity markets, especially mega cap, especially consumer discretionary. I need to think about where could I be wrong here? What if I'm wrong in this commodity trade? I mean, if I'm wrong and equity markets collapse, I'm fine, right? But what if I'm wrong? What if commodities are get crushed for whatever other reason that is not an inflation problem? It's a deflation problem, and I'm wrong on my thesis. What's the cheapest way to protect my portfolio? Well, I've done a lot of work on this, and it has to be the Chinese yuan. If the Chinese yuan collapses, it's not positive for oil. I'm not going to pretend here that it's positive for oil. I know it's not positive for oil. Now, is it the end of the oil trade? No, I don't think so. It would be a buying opportunity. If you see oil declining because the Chinese yuan devalue by 15, 20, 30, 50%, and oil goes back to 60, 50, you want to be a buyer of that. I will be selling my protection in the Chinese yuan devaluation to then buy commodities. That's what I would be doing. But I need to have that protection in the first place. So we're short the Chinese yuan. We've been shorting the Chinese yuan for the last 4 to 5 years. It works when you most need it. So again, when commodities start underperforming, that's the time when that trade is working. It saves your butt at those times. It's the best thing that you can have, in my opinion, in a portfolio. We're short the Hong Kong dollar for the same reason. I am short commodity importers, and I'm long commodity exporters, commodity-led economies. Brazil is an example of that. Now, I wish Canada and Australia would make more sense. I think there's a lot of macro problems there too. Therefore, I don't buy it. I would not short it either. And so, it's just ways of expressing your views in a portfolio. But yeah, I think China is much closer to a total implosion than, a leadership of becoming, the largest economy in the world. I mean, I think I'll take that trade all day.
I agree with you 100%, and I've been talking about it for a while. China has a problem with their working population. It's collapsing due to their one-child policy finally hitting their nail, and they are over-levered. You look at real estate, their financial industry, and at the same time, they have so much debt to GDP, and it's not a developed nation, right? Like, they're acting as they're a developed nation. I mean, their GDP is really high, but, not per capita. And you have all these manufacturing companies going outside of China, going to India, other areas, and so you have China that's collapsing, and now Europe, right, with the natural gas, like this is gonna really hit the nail with the economy. Cool.
Just a point, Julian, if you don't mind. Yes, there are some people talking about it, and you're smart enough to talk about this as well. The real problem is that from a positioning standpoint, do you know how many people are short the Chinese yuan today? How many people are expressing that view? Because if you're a market participant, you can have all these views about the market. If you're not trying to make money on those, you're not betting on your ideas. And it's amazing. I talk to people all the time, especially portfolio managers, and I ask them, are you short the Chinese yuan? I ask guys that were short the Chinese yuan in 2015, and they all made money, and they're saying, no, I'm not short that anymore. And so it's just amazes me that no one is really getting the conviction to really, I think this is going to collapse. How do I make money out of this? I mean, it seems very obvious, and then let's make money. And I don't see enough people positioning towards that. And to me, that's the definition of a black swan. It's when you have those major dislocations.
Yeah, I agree with you. I think a lot of it is related to Chinese propaganda that's spread out in the US. People talk, oh, look, China is so, it's the future, it's the future in tech and whatnot, but it's not. Just because they have one company that's doing well with 1 billion people doesn't mean that the economy is good. Cool. What about, the US in the long term? You talked about commodities, but why can't US companies do well in the next 5 to 10 years? You look at Apple, you have 500,000 iPhones being sold every day in the world. You have like the best tech companies, in the world that are based in the US. If you look everywhere else, if you look at, Europe, that's a third of the economy, they have much, like, the whole world has much worse problems compared to the US, looking at it, right? Like the Europe has energy problems, China, economy is collapsing. I mean, Brazil can do well, but the Brazilian economy, it's much smaller compared to the US, right? Will the US do well in the next 10 years?
I'm not in that camp. I mean, I mean, it could do well. If it goes flat and I'm short and I'm long commodities, I'll be fine. I think Apple. Let's just use Apple as an example. I'm going to be a major devil's advocate to your point. Okay, I think Apple certainly looks interesting, especially from a balance sheet perspective. They've got a lot of cash to deploy. The issue with Apple for me is that Apple is kind of exactly the model of China. I mean, how did China succeed? I mean, Apple basically is using cheap labor. It's importing most of their products and being assembled in the U.S., but everything is being imported. What happens if this relationship with China and the U.S. really turns sour? What happens if they have to, in 3 to 5 years, completely change their logistics to fix the issue? And I think they're doing that already, and a lot of companies are figuring that out and are having to make those changes. And that's another impact on the Chinese currency. What you're saying is the U.S. is bad, but it's not as bad as other places. Well, that reflects on the currency. I've never been a dollar bear. Never. You're never going to see me saying that I was a dollar bear at all, because I've never been a dollar bear. I've been an equity market bear, and for many reasons, because I think there's a growth to value transition. I think we're not going to see, if 10-year yields go to 4 to 5%, it's not positive for technology companies, period. I mean, I don't think that's positive. So every time you have, this, what was the trade of the last 5 to 10 years? It was technology. Do you want to be on this trade right now? I mean, do you really think this trade is going to be the trade of the next 5 to 10 years? I am not in that camp. I think we've seen tech. It's not the end of tech. Tech is always going to be around. There's always going to be innovations and one or two or few, number of companies that will do extremely well. Now, as a sector, I am not overweight tech for the next 5 to 10 years. So the U.S. is going to need a transition. That transition is going to be painful, meaning you're going to see those, traditional businesses doing better. You're going to see, manufacturing companies probably doing better than growth companies. You're probably going to see commodity-related companies doing better. And we forget about this, but the U.S. is a commodity-led economy. It's not like it's not. It has an abundance of commodities. It has a political pressure against developing those resources, but it has a lot of resources from the mining side, from the energy side, from agricultural side, from nuclear side, everything. They have literally everything. This is one of the most fortunate places in terms of natural resources you could find. Brazil is that way too. But the U.S. certainly is in that camp. And so it's hard for me to be a major dollar bear, but I do see the U.S. having a lot of problems. I mean, you have the debt problem, you got the inflation problem, and you got a valuation problem. That view that you're posing here is a view that has been already priced in the markets for the last 20 years. Right? I mean, everybody figured that out, and they were buying equity markets in the U.S. versus other places. And so I caution people, because it's not just Brazil is really underdeveloped relative to the U.S., so I don't want to touch Brazil. I don't think it's that way. It's not how I think a macro investor should be approaching this. If it's extremely underdeveloped, it has the opportunity to be developed. And I don't think Brazil is going to be, we've always called Brazil an emerging market. It never emerged to be a developed economy. It's still an emerging market for freaking 20 years, right? It's like, It's like, when is it going to emerge? And I don't know if it's going to even emerge in this commodity. Let's say I'm right, commodities do well in the next 5 to 10 years. Brazil does very well. Will Brazil be a developed economy at the end of this? I don't know. Do I need to be right about this? I don't think so either. But so I don't know. I have a few issues with companies like Apple. I think we've seen a big trend of software stocks decline a lot, and companies that don't make any money. Software companies actually made money, and they were with very hefty multiples. You had multiples of companies trading at 60, 70 times sales. You had DocuSign trading at a 50, $45 billion valuation. Like, I remember talking to some young analyst in, I don't know, it was October or September of 2021. I sat down with this guy who supposed was one of the most bullish people on DocuSign, and I asked him, give me the other side of the trade. I'm short DocuSign. I mean, can you tell me why I should not be short DocuSign? I mean, why is it a $50 billion? I understand it's, interesting. Everybody's using it to sign things electronically, but should that be a valuation of $50 billion? I couldn't believe it. And so, there were many examples. We're not there yet at all anymore, right? I mean, a lot of those software companies have been re-rated. What has not been re-rated? I mean, I think there's a lot of things. I think there's mega cap. Mega cap needs to be re-rated. Microsoft, Apple. I mean, if I pose a world to you, there's going to be a much more deglobalized world. That cannot be positive for Apple. That has to be negative. I mean, I don't know how that can be positive for a company like Apple. So it's not that I don't see how well they've done in the last 15, 20 years. Most of those are monopolies. They really are. And oligopolies too. In the case of Apple, you got Google, right? I mean, all those companies have done very, very well. But I don't think the capital trends are going to be favoring technology in the future. They're going to favor other things. And when capital shifts, something needs to be sold for something else needs to be for something to be bought. And especially in an environment where there's no excessive liquidity. And so, I think people are going to be selling those things to buy other things. And those other things would be probably commodities and kind of boring businesses, that did very well during value investing periods, which I think we're entering one. So,
yeah, I agree with Apple there. I think Apple is going to be maybe the first shoe to drop in this recession environment because you have dollar super strong, and then you have two major economies where they sell a lot of iPhones, like slowing down like crazy. So people will stop buying iPhones. But then I agree that, price over sales, like price over earnings went down a lot. But if you look historically, for example, for SaaS companies, it's in average, right? And interest rates, I think, can't go that much up, right? So if you have interest rates at 4% or whatever for a long time, that's not gonna change valuation. And I mean, just to go a little bit further on that argument, like if you look at Tesla, for example, right? You can argue they're overvalued, but if you think about it, right now they sell maybe 1 million, 2 million cars. I think 10 years from now, they may be selling 10 million cars, right? Maybe they are selling the majority of vehicles in the world. So when I think about tech, I think about Zoom, like everyone is going to use Zoom in the future, right? And so they still have a lot of growth to go, and their price to earnings was really high. But right now it's in average with historical terms, right? And if you look at when the CARES Act was passed, Druckenmiller has this interview where he talks about, when I think the bond market, there was a big sell-off. And what happened that day, there was a huge movement out of, bonds into technology companies. Because what happens when you can't buy, treasuries? What happens because you can't trust the U.S. government? What happens when you can't buy, Chinese companies or European companies, where does your money go? I mean, it may go to commodities, but I think a large part will go to tech companies in general. Like mega tech companies, I agree will go down, but maybe I'm wrong there.
Well, no, I mean you could be right. I, I can, I, I could have, maybe see your side. I mean, I think what you said about Tesla is basically priced in. I mean, if Tesla does what they say, which or what you said about 10 million cars and so forth, well, look, number one, copper is not going to be trading where it is right now. That's number one. Number two, yeah, and number two, Tesla already has a valuation that is larger than the entire auto industry combined. So, you know, it's basically priced in, right? I mean, it's like, all right, they better do that because if they don't, the price should not be there. So,
But the
so
profit margin is really high. Like the profit margin of Tesla is like 27%, and they already make anyway. Like Tesla is just one case.
right. I'm not an Elon Musk skeptic, by the way. I think the guy is extremely smart. I would not bet against, I'm short Tesla, but I wouldn't bet against Elon Musk ideas and so forth. I'm short Tesla for other reasons. It to us is a valuation proposition. It's a consumer discretionary business, right? It's another consumer discretion. I mean, what do you do in recessions? You talk about a Great Depression, anything like that. Do you buy luxury cars during that time? It's like, no, you save money. You can't just be buying cars like that if you're in a recession. So I don't see its value as a growth company in an environment that is massively slowing down. So to me, I don't know. It's not an environment. Zoom has geopolitical issues right there as well. I mean, it's unless it changed. I remember I used to be short Zoom. I'm not short Zoom anymore. And I lost money shorting Zoom too. I'm not saying this was a perfect trade. It was a very difficult trade. Zoom. The issue with Zoom is that really a monopoly? Is that really something a moat that they have that is different than any other company to figure that out somehow? I mean, I use Teams every day. I don't use Zoom. So I don't know. The other thing I was going to point out, the shift from bond markets to technology companies that Druckenmiller was referring to. Well, there was something else going on during that time. And that something else was that the Fed was doubling the size of the balance sheet. So, we're not seeing that right now. And I don't know, you look at NASDAQ chart, you take global, I'll post that chart at some point. I have it ready. I'm just working on a ladder and I want this to be a main chart. But I have a chart that shows global assets from central banks relative to NASDAQ, okay? It's the freaking same chart. It's the same chart. So it's like,
But like, do you think that the Fed will stop printing money? They can't stop. Like the debt to GDP is so low. Like they just stop, and then like for a few months, and the economy is gonna freak out. Like they will have to reverse course. They will have to print a lot of money. So if Japan is the future of the US will have to print more money and do yield curve controls, right?
well, here, how about this? Let's talk in about 9 months from now, and we'll see where this is going to be. And I think it's going to be in a much worse situation in about 12 months from now. I don't think the Fed's going to stop anytime soon. So we'll see. The press is in 40 minutes here, and I don't think that they're going to be slowing down. I think price stability is a priority and the mandate. Biden has been ridiculized by this whole situation. I mean, people are making fun of him, right? He's pissed. He wants this inflation issue to go away. And the only way to do that is to create a recession. And so everyone is on board with this, right? From a policy making perspective, they know this needs to happen. Unemployment rates are way too low because it's a lagging indicator. Everyone is seeing this as a sign, and it's not the sign you should be looking at. So it's like last year when unemployment rates at 20% or so, 15%, And every sign, leading indicator for labor markets was showing this is not going to be sustainable. It's going to go down to below 10%, and it went down below 5%. And no one cared. They were still printing money. They were still passing other, fiscal stimulus. And I don't know. This is different than that time. Very, very different.
But yeah, I would argue that inflation is bad, but what's worse is a depression. And once you get into a really bad, economic situation, which we're gonna like FedEx earnings are like that's the canary in the coal mine. We're already starting to see it, and next year is gonna be horrible because of Europe, China, and then you have all these macro factors. They will have to change course. They will have to change course. They will see, inflation 5% or whatever. They're like, we need to change course because of elections, the next cycle, not this cycle. But yeah, we'll see. I agree with you in the next year. It's going to be pretty bad for tech companies and US equities, but 5 to 10 years, I would argue I would belong US the US equity market. But yeah, I agree with your commodities and the Chinese yuan and everything else.
Yeah. I mean, it's important to go back to the 1910s and 1970s as an example, because in nominal terms, equity market in the US was flat. And I think that's unimaginable today. And a lot of people, I have my biases. I'm not saying I don't. I really do. You work on the technology sector. You have to understand you have a bias towards that because you feel excited about those projects. You're like, oh my gosh, this is going to be the next thing. It's going to be the next thing. And oh my gosh. And I understand that. I totally understand that. I think the people, we're probably similar ages, and people in our age are very much involved with growth investing, right? I think that if I was giving an advice, and who I am to give an advice to anybody on what the skills you should develop right now for the next 5 to 10 years, it wouldn't be about growth investing. It would be maybe you should learn about value investing. You go back and read, guys, David Einhorn, Bill Ackman, read about Leon Cooperman, read about, Warren Buffett, Paul Singer. Those guys are going to be in a position, they're going to kill it. They understand this market very well in terms of the value investing approach. And so I would be long all those guys versus all the growth guys. 100%. That's what and that's what I'm trying to do personally as well.
Yeah, cool. That was an awesome conversation. I think we'll wrap it up right now. Thank you so much for taking the time. This was awesome. I've learned a ton, and I think our viewers will learn a ton from you. Yeah, thank you again.
My pleasure. Yeah, speaking with another Brazilian, so it's great. Congrats on your work, and thanks for having me.
Thank you.